Today's review is about Why Does the Stock Market Go Up? A book by Brian Feroldi. Feroldi, when he was a young investor, gained an interest in the stock market and decided to research all he could about the stock market. However, there wasn't a good book that aptly explained all the difficult concepts, all the various topics in a neat, orderly manner. Therefore, he decided to write his own book, a book that he wished he had when he was a young investor. This book is Why Does the Stock Market Go Up? He put all the lessons he learned from the long years of investing in this book. The first lesson is, before you start investing, you must start saving. In a capitalist world, without using the power of investing, it is very hard to gain financial independence. However, savings is what's needed to gain that all-crucial principle. In order to do good investing, you need principle. And in order to maintain a very good principle base, you need to invest. You need to first put into a savings account. Therefore, one must save before they can invest. Also, you need to take care of personal finances first. One's own personal finances and a healthy financial balance is needed before you start investing. These include cutting down on spending, maintaining good spending habits, calculating your profits loss, as well as putting a bit of money as a emergency fund. Once you have these good habits in place, then it becomes the solid foundational base in which you can start investing. One must also use the power of compounding as well. Compounding is a very powerful force that, when used correctly in a very long time span, can be used to increase your financial portfolio, your foundational principle, many tens, hundreds of times. However, this can also work the other way. If you have a lot of debt, the power of compounding interest works against you, and instead you grow more and more into debt. Therefore, in order to gain the most out of your investing, you must decrease your debt as much as possible and increase the amount of money you have in good financial instruments. Also, in order to invest, when investing, you must always think in the long term. Long-term investing is crucial. Cash is an asset that in the short term is very safe, but in the long term is very risky. Inflation is always there, and the purchasing value of cash goes down as the years go by. However, stocks is the exact opposite. It is an asset that in the short term is very volatile and very risky, but in the long term, cost always goes up, and is the least risky asset. Therefore, humanity has always advanced and increased productivity, and this has been reflected in the stock market, and it has constantly risen in the past 100 years. However, volatility is very high, and also Wall Street is full of short-term traders and trading experts. Therefore, the shorter your time frame for investing, the easier it is to lose your money. Lastly, one should always be wary of penny stocks. The vast majority of penny stocks that are below $5, are cheap for a reason. There is something very, very wrong with their financial health, and this is why the stocks are cheap. As for early investors with very little principal, it might be tempting to look at these kinds of penny stocks. However, the risk is very clear, and one should always stay away if you want to minimize risk. This book, Why Does the Stock Market Go Up?, was a very general overview of the investing sphere and a very good overview of the financial market. Brian Frawley does a very good job explaining somewhat complicated concepts in a nice and simple manner. He constantly stresses that for everyone, for all people, investing does not have to be scary, and there are many ways to invest easily without that much risk. Humanity has always advanced and always increased productivity, and therefore the stock market will reflect this and will continue to go up. That is the core message. Therefore, it is the wisest choice to start investing at an early age and as early as possible. Thank you for listening.